partner in crime, is going to start this whole show. Let me see where she's at. Hey.
Hi, everyone.
Welcome everybody to the Queen of Funda trading, my partner, the great Forex queen, Lien herself, who I have the great honor of basically being friends and being colleagues for 20 years already. She's an amazing trader. I see her work every single day, and I got to tell you, when we talk about, we had that conversation with Mandy about all the mental difficulties of trading. You have to understand something about Kathy that I think almost nobody in the world of trading or trading gurus does. Kathy trades live, and I don't mean like live like I do 1 hour a day, and then the rest of the time, I put my feet up. I mean, she trades live 5 days a week from Asia session until usually midday New York, puts out tremendous amount of recommendations, real market prices, real market ideas with stops and targets. There is no hiding. It's just, you can't imagine the kind of pressure that is, I think, for a trader, where there's just, there's no hiding. There's not like, oh, get around this level, come out of this level. Yeah, maybe we'll add a little bit more. There's no iffy. This is hardcore. We either win, lose, or draw. And she manages those trades exceedingly well and exceedingly, well prepared. But most importantly, and she'll show it to you because I don't even want to tell you, what's astounding about this is I forgot how many months in a row, but it's like 30 months in a row, 40 months in a row, whatever it is. She has a record where she is literally like only 2 losing months out of the last 40 months. There are a million hedge funds that would give up their firstborn for half the kind of record she has. The amount of consistency she's able to achieve by being ultra focused and highly motivated. One of the things that I sort of wanted to ask her, because I watch this every day, but I was sort of in awe of her ability to just shrug off losses. What's amazing about Kathy is, yes, of course, everybody loses. If you're not losing, you're not trading. Okay, you're not trading for real. That's how the markets work. But she's just amazing in terms of, like, she'll hit 2 or 3 losers because the markets are just not cooperating, and then go right back in, take new trades, and make it all back without hesitation. And I kind of wanted to ask you, because to me that's really the most interesting thing. I love your approach. You're going to tell them the details of your approach. The really most interesting thing is the mental toughness that you display. How do you achieve that? How do you just let the market, don't let the market get to you?
Well, you're too kind for us. I want to say that it really comes down to trusting your strategy. As you said, the strategy and the technique that I've traded, we've traded this for years, and it's double-digit months in terms of its consistent profitability. So time in and time out, it works. And I would even say that the strategy would do better if I didn't break the rules as often as I do. I find, and part of the reason why I am able to go back in and keep trading, even though I may have, might be down 100 pips in one day, I can know that, if I stick to my strategy, I can still end up, either down single digits or up, or basically really kind of mitigate those losses, because I know that oftentimes the reason why I'm losing is because I'm breaking my own rules, and the strategy in of itself is solid, and that knowing and the results that it's experienced in the past through so many different market environments really helps you get an understanding of not only how I trade, but also how the strategy works.
Interesting. So I think that the key takeaway here, and I really appreciate this point, because I'm sort of getting to that level myself. The irony of the whole thing is that we have a very analytical, highly quantitative, sort of very rational strategy, both you and I. I mean, any strategy should be that way, right? But the missing ingredients, or the winning ingredients, is actually emotion. The winning ingredient in all of this is trust, which is something I think most people don't quite appreciate. You could have the greatest strategy in the world if you don't trust it, and that's something that can only be developed over a long period of time and a long period of experience. It's not going to succeed, and that is, I think, is a really interesting point that you're making.
I think that what's also part of the reason why I came to that was because I oftentimes will look back at my bad trades and the losers and try to get a sense of what happened and why that occurred. And if I realize that that occurred in an environment where I'm breaking my rules, then that has nothing to do with the strategy itself. It just has to do with me, and it has to do with my eagerness to get into a trade after news, even though I have a rule that says I really shouldn't. And if that's the case, it's not about the strategy, and it actually reinforces my confidence in the strategy more than anything else.
Wow, interesting. Really, really interesting. So one last question before I let you start. Market volatility in FX has plummeted. It's been, everybody who's been here, who's talked about, Blake was here talking about FX and everybody else about how much of a challenge it is. Do you find it challenging? How do you deal with it? What is your approach to dealing with the current low volatility environment that we're in?
That's a really interesting question. We've traded through, both you and I have traded through low volatility, high volatility environments. And I think that we've found the best way to really succeed in both environments is to use this kind of short target, long target strategy that we have. Because when you're in a low volatility environment, having a short target allows you to capture just small momentum moves, because even in a low volatility environment, you still have trends, you still have continuation. Right. Whereas in a higher volatility environment, having that long target allows you to participate in bigger moves like we had last week. So 2 or 3 weeks ago, we had very tight trading ranges and it was much harder to trade, but everything kind of blew up last week and it was great trading. And so having a short and long target really allows us to participate in both.
Interesting. Great. Thank you. Thanks a lot. Let me see if there's just any questions here to you that I want to just pass up. Just give me 1 sec before we start. No. Everybody's there asking you whether you should be using an algo. Algo questions go to me. I'll take them next on the next show. Okay, very good. Everybody seems to be really psyched and ready for your show. I'm going to make Kathy the presenter now. Give me just 1 second. She's going to grab the screen from me, and we're going to listen to her show. So I'm giving you the screen, Kay. Go right ahead. Super. Okay. We see your screen. Yep, you're good. I'm going to go off screen, and I'm going to let Kathy stay on screen. But I'll be in the background. If there's any questions or anything else, I'll pass them on to her. Okay, guys. All right.
Do you still see me in the? Yes.
Okay. You on the screen. So you look great. Yes.
All right. Sounds good. Okay. Everyone, thank you so much for joining me. It's nice to kick off the day. It's early. It's either early for some of you in the U.S. or it's evening time for some of you in Asia. It is midnight where I am right now. I'm currently sitting in Hawaii on vacation with my kids, but I'm staying up extra late just to be able to have some time with all of you and share with you my techniques on how I combine fundamentals and technicals to make consistent weekly profits. So hopefully, you'll find something valuable in my talk. And if you have questions, feel free to to put them into the chat screen. And towards the end, we'll get to those. I won't be able to see them right now, and I want to stay focused on sharing with you the information that I do want to share. Okay, so to begin. Trading Forex carries a high level of risk and may not be suitable for all investors, but this disclaimer basically says it's important to understand that trading Forex can be risky. So you need to make sure that you know what you're doing before you actually start trading. So I've been trading currencies since 1999, which seems like ages ago. It was ages ago. But from the very first day that I started trading currencies, my kind of philosophy had been set. And the reason why my philosophy had been set was because I traded, when I started my career, I traded at JP Morgan Chase, or JP Morgan at the time, on the interbank desk. And I sat with, all of the dealers, all of the market makers, and also the prop traders. And from the very beginning, they taught me how fundamentals are incorporated into their trade, and how fundamentals should be incorporated into my trades. And so my philosophy and the way I trade has really been, kind of something I've been using since 1999. But I've been in the market for a very long time, and through that time, I've been trading in low volatility markets, high volatility markets, and many different types of political, economic, and social regimes. And seeing all that has really allowed me to understand, when strategies thrive and when strategies, kind of are become sluggish. And that kind of, technique and knowledge really goes into everything that I do today. You may have seen me on CNBC, Boris as well. But, I do want to say that while, we may be talking about where we think Euro will be at the end of the year, 6 months, 12 months from now, what's the most important is that, while the long-term trajectory may be in one direction, at heart, I'm a trader first and an analyst second. It is important to consider where the Euro may be a year from now. But, for you and I, for, most of you who are listening to me right now who are retail FX traders, what's much more important is how am I going to make money today? How am I going to make money this week? So that's why at heart, I'm a trader first and an analyst second. So when it comes to trading, there's a lot of different types of approaches: fundamental versus technical, fade versus follow, day trade, or swing trading. And oftentimes when people start off in the markets, I will get asked, what's the best approach? And even to this day, people who've been in the markets for a while may struggle with trying to really get the sense of what the best approach is. And I think the answer really lies in this, which is know yourself and you will win all the battles. One of the questions that, Boris asked me when we kicked off our talk was, how do you get around these, days when you have losses? And it's really about, knowing your own personality and whether or not you can look past, 1 or 2 days of losses and be able to look at the bigger picture and having trust in your strategy. If that's not something you can do, then you need to make sure that you adapt your trading style to that. So having traded since 1999 and having traded, different variations of, this type of strategy, I know myself and I know that, yes, I may have had a really bad day, but I also trust my strategy and know that I can keep going, keep trading, and keep moving on. And, having that confidence in yourself really helps you determine whether, first of all, you should be a day trader or swing trader or trend follower or a fader, because these are very different personalities. I personally have a horrible time fading. Boris, for a very long time, was very much a fade trader, and he's adapted his style a bit these days. But I knew from the get-go that I hated picking tops and bottoms unless I had a really, really good reason. And so I've always been much more of a trend follower. And if you've learned any of the strategies that I've ever developed, it's almost always been much more about momentum and trend. But first, before we even get to the trading strategy, let's talk about why should we even consider fundamentals? Why are fundamentals important? Well, fundamentals are important because I always say that the best trades are the ones that are supported by fundamentals, sentiment, and technicals. And the reason for that is because fundamentals give you the reason why you should be in a trade. Sentiment determines the direction that the trade will move, whether or not the overall market, like a sentiment or over market direction, is in sync with your thesis. And technicals determines when you should buy or sell. So each and every one of these components are extraordinarily important. And having each and every one of these components as a part of your trade really it enhances its success or enhances its possibility of success. So whenever I get asked the question, should it be about fundamentals or technicals? Should I trade just purely in charts, or should I trade just in the global macro picture? I always say, they're stronger together. Having a fusion of fundamentals with technicals and using them both together creates the best, highest probability trades. It is how I am able to achieve. We'll have to look at the record, but I don't even remember, but it's probably about 28 out of, or 27 out of 30 winning months. And the reason is because with every single trade that I have, it's always a fusion of fundamentals and technicals. And when I break that When I try to go against the technicals, that's when I lose money. That's when I, as I said to Boris earlier, make those mistakes that, is not a mistake about the strategy, but a mistake about me breaking the rules of the strategy. So what are fundamentals about? Fundamentals are about the big story. They're about, the 4 years of Trump and what that meant for the markets, and how, with President Trump, throughout his 4-year term, every single big announcement or tweet that he would have could have huge, kind of ripples throughout the financial markets. And in this chart, you see here how Trump, the impact of Trump and some of the key events during his term, and how it affected the stock market, from him being inaugurated to the corporate tax cuts signing into law, and that caused stocks to shoot higher, to the first round of US-China tariffs, how the lead up to that led to a decline in equities. And in this chart here, you see how all of the key events around Trump led to very big moves in stocks. Also, fundamentals are, big story fundamentals are things that, are 100-year events, that don't happen out often, like the coronavirus, where the coronavirus had a huge impact on the world itself, as well as the stock market. The start of the pandemic, stocks crashed, aggressively. And when the first vaccine was announced, we saw new highs in equities. Why are we talking about, why am I showing all of this stuff in regards to stocks to you? And the reason is because stocks are a very important measure of overall market sentiment. And currencies oftentimes will take their cue from equities. And the stories that are moving equities are, very much the same stories that are moving currencies as well. And now, we're kind of in the phase where we went from, recession risk to recovery. And the recovery story is what's really going to drive, equities as well as currencies in the months ahead. And in fact, it has already been the leading driver of, of all markets in the past, few months. So, one of the most important terms that we use in when we talk about fundamentals, and what I just teased a little bit about, was sentiment, and how the attitude in the market, whether the risk appetite, has a huge impact on both the equity market as well as the currency market. And the reason for that is because the words risk on, risk off have significant ramifications to how you should be trading and how currencies are trading. And it's a very important component of my daily check marks for selecting trades. So before we even get further into talking about fundamentals, it's really, really important to truly understand what risk on, risk off means. So risk on basically means happy markets. It's like this picture of this gentleman here who seems very enthused by the way the chart is going. So risk on is an environment with low volatility, where stocks are rallying, commodity prices are rising, bond prices are falling, bond yields are rising, and we have a nice, beautiful rally in currencies. Risk off is the reverse, where we have high volatility, stocks are declining, commodities are falling, bond prices are rising, and bond yields are falling. And this man, like everyone else in the risk off environment, won't be very happy. And so risk on, risk off is a measure of how investors feel, whether they're optimistic and they're pleased to see where things are going, or whether they're worried. And I can assure you that when one of the most important things to know is that when we're in a risk on environment, rallies in currencies and equities tend to be really nice and leisurely and take their time, and with retracements within the overall trend as profit taking occurs. Risk off, when a deep sell-off occurs and everyone's trying to liquidate, it always moves faster, more aggressive, and more intensely than anyone would anticipate. So when we have a sell-off in stocks, we have a sell-off in currencies, and we have a crash, it always goes quicker and further than anyone would expect. And that's very, very important to realize. So the risk on currencies are basically Euro, Pound, Aussie, Kiwi, CAD. For some time, Euro was also a bit of a risk-off currency because it's low yields, but it's no longer the case. And most of the time it is not the case. In a risk-off environment, the currencies that do well are dollar, yen, and the Swiss franc. And so, in terms of Forex lingo, these are the most important things to remember. And this chart just illustrates the strong correlation between the euro dollar, which is the candlesticks, and the orange line, which is the S&P. And you can see, for the most part, these are mirror images of each other, with stocks oftentimes leading currencies. And that's why it is so important for anyone who is trading currencies and for anyone who wants to follow fundamentals to watch how equities are trading. This is this is just the same chart. Okay, so fundamentals, where do we start? Well, for those of you that are trying to get a grasp of fundamentals to begin with, we have to. Well, the way we should look at it is we should look at it as what moves stock market is in many ways the same things that moves the equity markets. Sorry, the currency markets. So if you're coming to the currency market for the very first time, it may seem daunting that you have to learn anything and everything about all of these 8 different countries, but that's not necessarily the case, because a lot of what moves equities is the same things that move currencies. Things like things that move stocks are corporate news and earnings, economic data, interest rates, comments by central banks, commodity prices, and market sentiment. Pretty much everything except for corporate news and earnings are the same things that move currencies. So if non-farm payrolls comes out and it's really good, it's probably going to be good for stocks as well as good for the US dollar. Interest rate changes, comments by central banks will move equities just like they move currencies. Same thing with commodity prices, and market sentiment, as we saw in those charts I just showed you, moves both. So when it comes to stock trading, we're typically, when we trade the story, trading the news, or trading the charts. Trading the stories means trading the valuation. Trading the news means trading the corporate announcements. And trading the charts is basically technical analysis. In Forex trading, trading the story means trading the economic outlook of that country and where interest rates are going. Because one of the great things about countries that may be different from stocks or one specific company, where you may have a corporate announcement about, let's say, the healthcare company, and they have some positive trial results for their vaccine, but then suddenly next day they may have some setbacks. With countries, for the most part, a country's outlook will get progressively better or will get progressively worse. And one of the beautiful things about trading fundamentals is that typically fundamentals do not change very often. You're either going to be bullish dollars for at least a few weeks, maybe in a few months, or you're going to be bearish euros for at least a few weeks, a few months. You don't go bullish, bearish, bullish, bearish, bullish, bearish unless there's very unexpected news. Trading the news means trading the economic reports, and trading the charts means looking at technical analysis. So in many ways, the same things that you use to trade stocks can be the same things that you use to trade Forex. But of course, the best technique is a fusion of technicals and fundamentals. When it comes to looking at fundamentals, it's the best way to approach it is to take a top-down approach. Start with the big stories. Start with what's happening in the global economy. What are the big things that are moving the markets? And then you get into the nitty-gritty, the smaller items that may impact a specific country, as opposed to the big story that impacts all the markets. So in order to get a sense of how these things work, the best way to approach them, in my opinion, is to look at it from the perspective of 3 M's. The 3 M's are the 3 fundamentals that count: macro, micro, and monetary policy. Macro basically determines the overall trends, the big moves in the markets. So for example, the global recovery story. The global recovery story is a huge story. Post-pandemic recovery story is a huge story. And that determines the trends of not only where equities are going and how we're seeing all these record highs, but also where currencies are going. Because when it comes to currencies, you have some countries that are reopening and recovering and growing faster than others, and some central banks that are much more optimistic and proactive than other central banks that may not be. Micro basically pertains to what impacts the daily moves of the currency. Like, we have ISMs and non-farm payrolls coming out in the coming week. Will have a significant effect on how currencies move, and that is what we're talking about in regards to micro. And then monetary policy. Monetary policy is going to be a huge story in the second half of the year, because monetary policy is about monetary policy divergence, meaning that, and the biggest opportunities in currencies in terms of big macro trends are when we have monetary policy divergence, where some central banks are unwinding some stimulus and others are not. And this creates a lot of opportunities and big, possibly big breakouts in some of the crosses. So with macro, we're talking about the big stories, political uncertainties, where commodity prices are going, the geopolitical risks, natural disasters, the health crisis. Those are some of the big stories. And in the past, few years, the big stories have been like Brexit, the recession that came out of the pandemic, the coronavirus itself, trade wars during President Trump's term. There hasn't been any specific war itself, but trade wars is the war that's been happening in regards to the big stories that impact the G10 currencies. Micro is basically economic data, and the economic data that matters are employment reports. Those are very market moving. Consumer spending numbers, which are very market moving. GDP reports, inflation data, and activity data. And when it comes to monetary policy, the most important things to realize is that it's important to know the players, know the mandates, and prepare properly, because every single central bank has a different approach and has different things that are more important to them. And understanding what those things are will help you get a better grasp of fundamentals. The way I like to look at it is to put yourselves into the shoes of the central bank and try to think like a central banker. Because monetary policy divergence is truly where the best and biggest opportunities are. Take a look at this, where back in late April, early May, Bank of Canada was the first central bank out of the gate to start to unwind some of their extraordinarily stimulus. And they were the first central bank to taper the asset purchases. And look what happened to dollar CAD when they decided to do that. At the time, the Federal Reserve wasn't even thinking about tapering, and they weren't, the U.S. was recovering, was reopening, but that really wasn't in the conversation at all. And Powell was being very, very conservative and kept on emphasizing that inflation was going to be transitory. But the Bank of Canada didn't care. They felt that, whatever's happening in the future was significant enough for them to start unwinding stimulus so they can prevent any sort of runaway crisis in the future. So they decided to taper, and that led to, a move that basically took dollar CAD from 126.50 down to 126.20.50. So a 600-point move over the course of the month. And that's the type of monetary policy-driven fundamental moves that we can expect in currencies. The Bank of England was the second major central bank to taper. And same story, when they decided to reduce their asset purchases, they created a very, very nice rally and put an underlying bid underneath the British pounds. And they took sterling from 138 all the way up to 142.50. We, was it last week or 2 weeks ago, we had, or basically last week was the Fed, and the week before that, we had the ECB meeting. And this is the chart of the euro. And we also, at the time, if you remember, the ECB basically said that the ECB actually said nothing. They avoided talking taper, and as a result, led to a little bit of a decline in the euro to the right of the arrow that you see there. But then the Fed came in and they said, you know what? I think we talked about talking about tapering, and that created a huge rally in the U.S. dollar that really accelerated the slide in the euro dollar. It just shows you the power of fundamentals and how big of the moves it can have, and how it can really set the stage for how a currency moves for not only that day, but for days and weeks to come. So You may be listening to me, talk about all this, and you may be thinking, okay, that sounds all really great, Kathy, but how do I turn these macro views into trading opportunities? How do I do this myself? Great question. Well, the first thing you have to do is, take a step back, and it's really important to kind of form clear fundamental views. So every single week before the week starts, I put together what I call my fundamental heat map, and this is what we do for our BK Forex members. And if they clicked on any of these tiles, it would expand into an explanation. But every week, these fundamental views are updated. And I'll be honest, sometimes they change, sometimes they don't. It really depends upon whether or not there's developments at that time. But you basically write to yourself, what are my fundamental views? This is an older screenshot. I mean, right now I would say, okay, I'm bullish dollars because the Federal Reserve made it very clear that they are ready to think about tapering. And that even though there have been some weakness in US data, they're looking past that. They expect improvements. So I'm going to be bullish dollars because they're ready to move and could even end up tapering asset purchases this year. So, I'm going to write down on my notepad, if I were you, bullish dollars for the week. So hopefully I'll only be looking for opportunities to buy dollars. I may be, if I'm neutral euros, then what that would mean is that, I can take any signal. I can take a buy euro signal, I can take a sell euro signal, as long as it is paired with, for example, a bullish dollar signal or a bearish pound signal based upon these tiles here. That's how I would mix and match. So I would independently form my fundamental views for each of these different currencies. And then when the technical signal comes up, I will refer back here. I'll say, okay, my technical signal says that I should buy pound yen. And then if I went back to this table and said, well, I'm actually bearish pounds and bullish yen, maybe I shouldn't take this trade. If I had a really good reason, maybe I would. But if I didn't have a good reason, I'm just looking at the charts, then this would be a reason not to take the trade. So basically the fundamentals help me filter out bad trades. And then, when you've formed your clear fundamental views, that's when you bring in your technical analysis. So this is what I look at. This is basically my proprietary indicator, the zip indicator. And I'll go into this in more detail, but what I do is I form my fundamental views and I only take the trades that are consistent with my fundamental views. So this is a recent chart, and on this chart here, or even if you take a step back, it's you will know that the ECB has been dovish. The Bank of England was the first to taper. So that kind of was set back in late April, early May. And so since late April, early May, I've been bearish euro pounds because the ECB has been, lagging behind the Bank of England. And so so every single time we had a sell euro pound signal, that would be confirmative to my overall fundamental view. So you can see here that those sell euro pound signals where the candle turned white and moved below the indicator line were the points where I would basically sell euro pound. So fundamentals determines the reason why, as well as general trades that I want to take, and technicals is what I use for my entry and exit. So in this case, those are the points at which my strategy signaled to sell the euro pound. We'll get more into that later, but it just gives you a sense of how I use fundamentals and technicals. Here's another example. This is FOMC. This is a 1-hour chart of dollar yen after FOMC. And these are just moving averages. So let's imagine let's say you don't know my strategy and you only use moving averages. And the very simple moving average strategy is where we have a 20-period moving average, which is the gold line, and the purple line or blue line is the 50 moving average. So one very simple strategy is, okay, if the currency pair closes above both of those lines, then we're above both of those moving averages, you buy. So let's imagine this is one of your simple strategies. So we know that at FOMC, we just talked about how the Fed talked about talking about tapering. I'm sorry, I'm from New York. I talk a million miles per hour, and also have a lot to say today for you today, which is why I am talking so quickly. But anyway, FOMC dollar yen positive. Let's imagine you're trading moving averages. It closes above both of those moving averages, and you're waiting for the next signal because, you know, obviously you wouldn't have, maybe you would have bought after FOMC day, but let's say you're waiting for the next signal. The first signal after that to the right is a false signal. It does close above both the moving averages, but then stops you out. But that's okay because, you know, you keep going. And we have a short target and we have a long target. And the second one is where you get a really, really nice, beautiful extended trade, because fundamentally, fundamentally dollar yen should be trading higher because of the implications of the Fed announcement. So even though the first trade didn't work out so well, the second trade really had very nice continuation. So it's really important to have a well-defined strategy. You know, it's really important to have have a clear idea of what you are thinking about in terms of fundamentals. But it's also very important to have a well-defined trading strategy. Having a well-defined trading strategy basically helps you have a clear goal. It helps you, create some sort of consistency. And it also helps you limit losses and maintains, or helps to achieve high accuracy. Why is setting a clear goal so important? You know, setting a clear goal and having a clear goal is one of those things that really transformed my trading in the past few years. Because, you know, when I first started trading, it was very haphazard. I focused purely on the trade and the setup itself, and hoped that the pips would tally up at the end of the week. But then, you know, I started looking at it from a different perspective, and I started looking at it from the perspective of having a very clear week-to-week goal. And having that clear week-to-week goal actually completely transformed my trading in a number of different ways. So to start, this is my goal. My goal is to make 100 pips a week, 400 pips a month, 3,000 to 4,000 pips a year. So what does this goal do for me? So what this goal does for me is that when I start trading at the beginning of the week, I usually tend to be, you know, more aggressive. And I tend to be more aggressive because, you know, I always look at the week as if I'm flat. So I start the week completely flat, and I look at it as if I start the week with 0 pips. So when I start the week, I can be a bit more aggressive and, you know, try to make those pips as quickly as possible. And if I'm able to achieve that 100 pip target within, you know, within Monday or Tuesday, then what I'll end up doing is I'll start to trade more conservatively. I'll trade more conservatively in order to protect my profits. I may get out of a trade a little earlier because I want to protect my profits, and I want to, you know, maintain and slowly increase that 100 pip that we've already accrued. And then another way that it helps me is that it gives me a clean slate, because at the end of the week, I'll close out all my trades. And so if I've had a bad week, no big deal. If I've had a bad week, I'll just look at it as if I'm starting the next week flat again. So it helps me kind of a clear mindset. So Boris asked me in the very beginning, you know, how do I keep going even when I have, you know, some bad weeks? And having this clear goal is really important psychological component of my trading, because it helps me reset every single week. So yes, my goal is 100 pips a week, and by having 100 pips a week goal, we can slowly accrue to 400 pips a month, 3,000 to 4,000 pips a year. And we've done that. These are the results just going back April 2020. They are even better past that, but it would be a really long table that would go way past my slide. But you can see between April to June, there's only been three losing months, and only one that was really, you know, that terrible, which is, you know, in May. And honestly, I'll be the first to admit that I broke a lot of my own rules during that month for whatever reason, and that was the only reason why we had losses. But month after month, the strategy really proves its efficacy. And this shows you what's beneath the hood, where every single day we're trading and we're slowly adding up the pips. Monday, Tuesday, Wednesday. This was for last week before, or this past week. I left for vacation on Thursday. On Monday we made 78 pips. On Tuesday we made 63 pips. On Wednesday we made 40 pips. Then I went on vacation, flew out to Hawaii, which is where I am right now. And I'll be back with our traders trading the Sunday session later tonight. So it's truly, so having a good strategy is about having, for me, is about having a fusion of fundamentals and technicals, stronger together. And so this is how I achieve 100 pips a week, which is combining fundamentals with technicals. And the technical component of my trading is something that I designed to make it easier for myself, because I felt that having a visual indicator would simplify my analysis, give me a quick and easy way to identify trades, helps to foster patience because I'm not looking at a million different indicators, and it helps me achieve my goal. It basically makes trading much more simpler and digestible every single day. And so my strategy is called the ZIP strategy, and the indicator that I use is the ZIP Trader. How does ZIP Trader work? ZIP Trader is a short-term momentum indicator, and it looks something like this. And the way the ZIP Trader works is that the background color is the overall longer-term trend. There's a lot of complicated math code behind it, and I can thank Boris for helping me set this up, because I am not the coder, but the background is the long-term trend. The blue line is the indicator line. So when the currency pair, let's say the first green section, when the currency pair closes above the indicator line and the background is green, then that is a buy signal, and the candle will turn green. And this is on TradingView. My indicator is designed for TradingView charts. And then later on, you see that when the currency pair drops below the indicator line and the background is red, then that is a sell signal. So of course, I don't take every single signal. I take the ones that are supported by fundamentals. So in this chart here, you can see that when there's sell signal, the candle will turn white with the red background, and when it's a buy signal, the candle will turn green with the green background. The ZIP Trader, having this visual indicator helps to give simplicity in my analysis while also incorporating the overall trends, because it incorporates the overall trend by the background color. So I can just open my chart and just visually I can see, are we in a downtrend environment, or are we in an uptrend environment? Should I be looking for opportunities to buy, or should I be looking for opportunities to sell? So what we want to do with ZIP Trader is that you want to buy when the long and short-term trend shifts positive. So here's a classic example where the long-term trend is green, the short-term trend is denoted by the candle itself. So long-term trend is green, so long-term trend is in buy zone. The short-term trend has a candle going above the indicator line, so the short-term trend is also buy. So we have the long-term trend and the short-term trend consistent. That's when you get your buy signal. So you want to sell when the long-term and the short-term turns negative. So here we have a sell signal where the background is red and the currency pair drops below the indicator line. And so the long-term and short-term trends are negative, giving me a sell signal. But just because the signal happens does not mean that we take a trade. We've already said that we have to make sure it's consistent with our fundamentals. But timing also matters. So, at the beginning of this talk, Boris says, how do you keep trading? And, one of the most important things is to really understand your strategy. And that's really the answer. is to know yourself and know your strategy. Now I know that my strategy performs best basically between 5 to 9 a.m. New York time and 7 p.m. to 10 p.m. New York time. And the reason for that is because, first of all, 5 to 9 a.m. is the New York Open, and it's one of the most liquid times of the day. And that's when we have carryover from whatever happened in Europe is carrying over into early North American trade. In Asia, 7 to 10, same story, where whatever's happens in North America, you're starting to get carryover into Asia. The worst time to trade is actually 9 to 1. It is perfectly fine. It's really great to have the strategy or the trade open already, riding through that time. But the signals that come out, around between 9 and 1, tend to be far less effective than the signals that come out, during the best times to trade. And the reason is because, typically at 9 a.m. you have the U.S. stock market open. You've got a burst of activity. And that burst of activity oftentimes does not have continuation. Oftentimes when we have the New York stock market open, my targets are hit as a result of the open. And if you have an experience trading stocks, you'll know that you get a flush at the open and then you get a reversal of whatever happened initially. And so you don't want to be faked out by taking a false signal that occurs at that time. And then after that, you start to get into the London close. And as you get into the London close, what ends up happening is that things start to get unwound, and you don't get the continuation anymore. So I know that my strategy is a continuation strategy. So it works best when there are times of continuation. 5 to 7 p.m. New York time, the dead of Asia, there's no continuation. And that's why timing matters. That's why I understand my strategy, and I understand that these are the best times to trade it. And those are the only times that I should trade it. And when I break those rules, I lose money. Incorporate fundamental analysis and macro views. And as I said earlier, form clear fundamental views at the very start of the week, and try to only take trades in the direction of those views. I do that already for all of our BK Forex members, and we've referred to them, throughout as the week progresses. Incorporate market dynamics. In the very beginning of the talk, I talked about risk on, risk off. I talked about how stocks were doing. I talked about how it's important to look at stocks. And this is extraordinarily important in my trade, and I think should be important in your trade as well. So when I get my my zip trader signal to buy or sell, the first thing I do is I check my fundamental Cathy heat map to make sure that's consistent with my views. Then I also check the time, make sure that this is during my trading time. After that, I see if it's consistent with how stocks are doing, meaning that if I get a signal to buy dollar yen, I want to see stocks doing well. I don't want to see stock futures down 100 points, because that's more consistent with a short dollar yen trade than a long dollar yen trade. I also don't want to see 10-year treasury yields down 3%, because 10-year treasury yields are down 3%. That's negative for dollars and not positive. So I want to make sure that the stock market, the bond market, and whatever's happening, if it's a cross trade, the relative strength is consistent with, is supportive and consistent with the trading signal that I'm getting from my technical indicator, Zip Trader. So where do I get this information? Basically, it's not that hard. You get this information from TradingView itself. When you put up a TradingView chart, TradingView is completely free. They don't pay me anything to talk about them, but you can add in your watch list what the S&P future is doing, how bonds are doing, and anything else you want. So I have, all of the equity markets and all the bond markets basically in my watch list, along with the currencies. You could also turn on CNBC, and the little corner, they have a little box that will tell you what futures are doing and what bond futures and stock futures are doing as well. And so, when you get everything in sync, then that's when the beautiful zip trades happen. So we have a beautiful, dollar yen zip trade. I trade these on 1-hour charts, setting up here at 110.60, and it led to a 300-point slide in dollar yen. I will be the first to admit to you, I did not capture, 300 points in dollar yen. We got a very small sliver of this because it's all about, consistency and doing this again and again, but it just shows you the power of these trades. With this dollar yen trade, it was really beautiful because we had, US and Japanese fundamentals on our side. Clicked on those tiles, they spanned explaining why dollar yen was a good short trade at the time. But there's one additional piece of the puzzle, which is moving average clearance. Before I take the trade, I always look for moving average clearance. And this is a very, very important part of my strategy. What that means is I want to make sure that I'm only buying when I'm above all the moving averages. And I'm always selling when I'm below all of the moving averages, because I don't want to buy into resistance or sell into support. I want to make sure I have clearance. And when we had a dollar yen sell signal in the other chart, that's where that's where the arrow to the right is pointing, where the currency pair dollar yen was below all of the moving averages. So it basically supported my trade. Here's another example of moving average clearance. So the first example, we actually had a fake out, but in the second example, it was when we broke through all three moving averages, we had a very, very nice extended sell-off in the euro dollar. And when it finally broke above all of the moving averages on the upside, we had a very nice rally in the euro dollar. So this, once again, goes to show the power and the importance of moving average clearance. So dollar yen trade, we had the fundamentals, and that's what gave us having fundamentals on our side, moving average clearance, having the markets on our side, and stocks, bonds, which I didn't snapshot, but we did, is what gives us the really, really generous zip trades. So the perfect trades, these are just examples of trades that we've had in zip, where dollar Swiss crossed below the indicator line. We had a really nice move there at the time. We had the currency pair drop below all of the moving averages, so we have moving average clearance. Here's another example here. Kiwi dollar rose above the indicator line. We got a buy signal, and at the time, Kiwi dollar was had been above all the major moving averages for a very long time. So we had support from that end as well. So in a nutshell, with zip, the trading rules are: you buy when the candle turns white, you sell when the candle turns red, and we trade in with two units. The first unit is only a 20 pip target. When the first target is hit, you move your stop to break even, and then your second target is 40 pips. So basically, this trade, if the whole trade fulfills itself, gives us 60 pips with the stop of usually I'm running a stop now of 35 pips only. So it's a 35 pip stop, 60 pip ultimate target. So one of the big issues that a lot of traders had and who trade Forex, and they talked yesterday, talked about the low volatility environment. Having a short target and having a long target is how we are able to thrive in a low volatility and a high volatility environment. And this shows you, Kiwi dollar was more of a lower volatility, slow mover. Dollar Swiss was a much more aggressive, big mover. In this case, we've gotten T1 and T2. So how can you apply this to any strategy? Basically, you can apply fundamentals to any strategy. You can apply what I talked about today in a number of different ways to your strategy, which is number one, make sure that you only take trades where fundamentals are on your side. That helps you get a higher probability trade. And whatever you're trading, if you have moving average clearance, that will help to increase the accuracy as well. Because my philosophy is really about high accuracy, high probability. I feel like a lot of people, when they come to FX trading, they always try to look for high profit trades where you're risking 1 to make 3, or you're risking 50 pips to make 100 pips, which is great in theory, but in practice, it's what if you missed that one great trade? What if you have loser, that one big trade is supposed to cover all those losses, but you were off the desk at the time. That's the worst thing that's happened. And even psychologically, it's really psychologically hobbling. And that's what to have loser. And that's really what causes you to question your own strategy. So having small consistent winners is really what reinforces the strategy, your results, and your confidence in the strategy. ZIP has a whole bunch of other ways to trade it, such as the retrace to ZIP indicator line. Like you could trade the retrace to ZIP indicator line where I show you here. That is another different way to trade ZIP. We also trade ZIP. Another variation is where ZIP crosses the line with a huge change, one candle before, so it's slightly late, where basically it crosses below the indicator line, and then the next candle, the background is red. When this setup occurs, it's still good, and actually it's a very powerful signal. It just means that the candle, the technical indicators are catching up with the price action. And here's another example of where we don't have the white candle, but we did have Aussie dollar rise above the indicator line, and then the background turned green in the next candle. And the third way to trade ZIP is one of my favorite ways, is to look for a double, triple, quadruple ZIP, where we have multiple ZIP signals. The more the better. 1, 2, 3 to the left of my candle. 3 green candles here in ZIP. Now this one only gave us the first target, which is okay. But sometimes like if you look on the left-hand side of the chart, you have 1, 2, 3, and the third candle gave us a really, really big move in Kiwi CAD. And here's another example. This is double ZIP. 1, 2, really big move in Euro Aussie. And the fourth way to trade ZIP is an earlier ZIP, where you basically get in a little bit before the ZIP candle happens. So what is the ZIP trade? The ZIP trade is trading the classic way, where we basically look for it to close above the indicator line. The background's the same color, creating a white candle on the indicator. But you can also trade a retrace to the ZIP indicator line. You can also trade ZIP when it crosses the line with a huge change one candle before. Double or triple ZIP, one of my favorites, as well as earlier ZIPs. So how does the ZIP trader work? ZIP trader is a short-term, or why does the ZIP trader work? It works because it's a short-term momentum indicator on 1-hour charts. It incorporates the broader trends. It buys when the overall trend is positive and sells when the overall trend is negative. It trades only in the best times of the day that supports the strategy, and we only take the trades that are supported by fundamentals and market dynamics. So while I am telling you all about my strategy, these are the same principles that you can use for your own strategy, which is that you should only buy when the long-term, when you have a signal, you should only buy when the long-term trend is positive. You should only sell when the long-term trend is negative. And you should try not, if you have a breakout strategy, don't trade during quiet time, trade during a big time. And you only want to take trades that are supported by fundamentals and ideally, daily market dynamics, like whether it's risk on, risk off, how stocks are doing, and how bonds are doing as well. And that's how we get to 100 pips a week with consistency, limited losses, and high accuracy. And that's how I get to these results that you see here.
Thank you, Kay. That was amazing. She just crammed literally a lifetime's worth of knowledge into 1 hour for you guys. And I know there's been so many, everybody is screaming at me, can you please, please, please get her presentation? I promise you, you'll get her presentation, you'll have her video, you can watch this on demand as many times as you like because there's just so many gems in there. There are a couple of questions in the audience that I wanted to, they're all impressed, Kay, they all love you. She actually stole half my presentation at this point, so I'm just going to let her run the rest of the show at this point. Because the irony of the whole thing is that I used to be very much the opposite trader of Kathy. I used to be what's called a fade trader, and I've actually come very much to her point of view, and my results have really improved. But the questions I have for you, Kay, a couple of questions. Somebody is saying here, let me just come back to this. One of the bigger questions, first of all, there was a question here, what book do you recommend for Forex trading? And I took the liberty of saying the book that is really, really worthwhile is the little book of currency trading that Kathy wrote. I put the link into the chat. All of you guys go into Amazon if you haven't read that. That's really the fundamental book you want to read. But one other question was here, somebody was saying that, what do you think about traders who only trade on technicals, that is, they ignore news completely? What is your attitude towards that approach?
Well, I mean, basically, I akin it to a driver driving with blinders on, where you don't know if the cars, what's going on with the cars to the left, the cars to the right, just driving in a straight line, hoping that no one will crash into you. It's really important to take a look at what's going on in the world around you. And while some traders will trade technicals and that maybe they're successful, I feel that you can really increase your chance of success and your results by incorporating fundamentals, taking a look at what's going on around the world.
Right, absolutely. I mean, I agree with that completely. I think you need a 360-degree. The markets are very, very hard. Basically, cutting off one very important data stream from the market is just it hurts you. It doesn't really help you at all. Somebody's asking, how can we get the zip? Can you get the zip trader indicator for MT4? No, MT4 does not have the visuals that TradingView does. So we do have lots of MT4 tools, and I'm going to share them with you in my presentation. But no, this is one of the beautiful things that we've tried to develop is all these visual tools. I have my own visual tools that you'll see, and they really make a huge difference. So the way everybody trades with us is they look at trade setups on TradingView and they execute on MT4, if you like. So let's see if there's anything other questions coming up here. I think I've answered most of them for you guys, and we do have. Oh, are you still? Somebody's asking you about Bollinger Bands. Are you still a fan of Bollinger Bands, primary and secondary? What's your attitude on that? They're asking you about that strategy.
Yeah, actually, I still use my Bollinger Bands as confirmation signals for this, and I use my Bollinger Bands more for kind of bigger trades to make sure that basically for the bigger trades.
Right. Very good. Sorry, let me see if there's if two countries are both bullish. Okay, if somebody's saying if there's this is an interesting fundamental question. If both central banks are bullish, or if let's say two currency pairs are bullish, how do you choose the relative strength of one versus the other?
Good question. First of all, it's not just about the central bank. It's also about where the economies are going, whether one is recovering faster than the other. But oftentimes, you're absolutely right. The tiles will show bullish for two currencies. In that case, there's two things that matter. First of all, it's the relative strength, whether that given day or week we had, more good data from one country or another. Or at the same time, it could just be, because they're both bullish, if that signal comes up to buy, then it could be fair game. I don't think that it's, as long as you're not going against and the fundamental idea where you're buying a bearish outlook, then I think for the most part, it should be fine.
Okay. You know what? I'm gonna come back on camera because I wanna talk to you a little bit more here. So the couple of other questions here that are interesting. One of them is, do you only do intraday signals, or do you do longer term signals? I know the answer to that, but I'll let you answer it. Go ahead.
Sometimes the trades that I have will last for a couple of days. I have two channels, as you saw. One is the Kathy trade signals. The other one is the smooth 40 signals. And the smooth 40 signals tend to be a bit slower and can last for a bit more time.
Right, exactly. The smooth 40 signals, the second channel that Kathy has, actually general length of those is between 12 to 48 hours, so they tend to be much smoother. And then the final question, I think, hopefully you can tell us a little bit about. People want to know, how do we get the Zip Trader? How do we get access to all that stuff? And perhaps you could share with them what are the things that you'd like to offer the audience, because they seem to be very eager at getting your ideas.
Yeah, we've got a lot of free stuff for you. From both Boris and myself, we've got a lot of free stuff courtesy of our partnership with Eightcap. First off, we talked a lot about fundamentals, and there's so much more to talk about fundamentals. And everything I shared, I talked very quickly, but there's so much more I think you could learn. So we've got a Master Forex Fundamentals course, which is valued at $375. It's completely free to you. It's a 7-hour course. All you need to do is to open up an account with Eightcap and deposit at least $100. In that course, it covers the ABCs of Forex fundamentals, what moves FX, the business cycle, what is QE, why do bonds matter, how do we determine risk on, risk off, rather than just seeing what they are, how to think like a central banker, and trading tips for every major currency. A wealth of knowledge, 7 hours worth of videos, completely free to you.
And especially designed for, there's a lot of people in the room that are saying, I'm new to Forex, I don't know how to trade this, I'm really interested. This is really designed for you. If you are new to Forex, if you're just starting out, or if you just want to sharpen your skill sets, all of this is perfect. And the entry fee is nothing. You just simply open up an account with Eightcap for a nominal amount of $100, and you'll be able to have access to this course, which we've taken hours and hours and hours to prepare for you. And then the next
for those of you that want access to ZipTrader and get trade ideas from Boris and myself every single day, it's also available to you completely free. We've got Forex swing trades that target 100 pips a week that I send out to you. You can live trade with Boris every single day, and he's got ideas targeting 1 to 2% a week. We've got 3 to 5 ideas every day. All of our visual trading tools, our 24-hour live trading room, our live market webinars, our instant exclusive BK Forex dashboard. So you basically have access to all of that, as well as the ability to learn new strategies. If you join Eightcap and you deposit at least $2,500, prove that you're actually going to trade. So deposit $2,500. They want you to make a few trades, and then you'll get that free course, as well as 3 months of BK Forex, access to BK Forex trading ideas. Normally,
which is really like the perfect way to sample our service, because you can sample it once a week or twice a week, and it's just, some of the weeks are going to be awesome, some weeks are going to be not so good, but over a 3-month period, you really see the value of consistent long-term trading. So it's a perfect way to sample our services. Go ahead.
Right. Normally, with our partnership with Eightcap, if you open up an account, you get 2 months with a $2,500 deposit. But for 1 week only, we are adding on 1 bonus month. All of these offers, include nice little enhancements if you open up, during our TraderFest week. Right. And then lastly, the most exciting thing that Boris and I are doing is the opportunities to give you the opportunity to trade our money, and also give you the tools to help you become a better trader. I'm hoping, Boris will share some of those tools with you during his talk, but you get to trade up to $250,000 of our money, and you get to keep 100% of the first $3,000 of profits and 80% of anything above that. All you have to do is to choose your account size, prove to us that you can trade, and these are for our advanced traders. And if you can prove to us that you can trade, which means that you can make 10%, you hit the 10% profit target without breaking the loss limits, then we'll evaluate your account for funding, and if you qualify, you get to keep 100% of the profits. As a part of the process, we will give you a suite of one-click execution tools, because we want you to be able to become a profitable trader. We want you to trade for us so that you can help us make money. So we're giving you tools to help you become a more effective trader. That includes a risk control wrapper, close all trades with 1 click, a trailing stop tool, automatically move to break even. These are MT4, MT5 tools, how to ladder entries and exits, and instant stops at swing highs and swing lows. And this is a great, kind of a teaser into what, Boris will share with you. So with our program at Newly Funded Traders, you get, information on analyzing your trades, a generous payout, no recurring fees, and you can trade from anywhere you want, a whole bunch of one-click execution tools, along with trading strategies, as well as 50 hours of online lessons. So we really try to give you a lot of resources that you can use to help you achieve your 10% profit target without breaching your loss limit rules. All you need to do is deposit $5,000 with Eightcap because they've sponsored this offer. Make your first 5 trades and you get the Master Fundamentals course, 3-month access to our trading signals, as well as the opportunity to trade $50,000 of our money.
That's right. I've sent the link in the chat box, so you should be able to see the link in the chat box if you want to get it. But we'll be sending it to you anyway, so you'll be able to access all this information. Hopefully, you'll take advantage of it. We try to address the newbie, the enthusiast, and the pro, and offer you a whole bunch of really interesting packages. Hopefully, you guys will really like it. I thank you so much, Kay. Kay, she went a little bit over time, but it was well worth it because amazing amount of information. So we're going to let her go. It's very late for her. She really deserves a little bit of a rest.
Yeah, it's 1 a.m. in Hawaii right now.
She's really been a trooper for hanging out with me this late. I'm going to take the screen back to me. Let me see if I can change presenter back to me.
Thank you everyone for joining me today and have a great show.
Thank you so much, Kate. Take care.